Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your Edutrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your Edutrainer and coach for our Edutrainment Workshops, our entry-level introduction into life insurance. And all this week we're doing our introduction into Index Universal Life. And today's course, we're going to talk about some more fundamentals just to make sure that we're prepped and really understand the basic foundational thinking of Index Universal Life. Now, to help you do this, we need you to download what we consider the best software, and it's a great tutorial right from Lincoln Benefit Life. You go out to their site, www.lblsales.com/ETW. As soon as you come to this page, you'll see Eclipse Illustration Software Installer. Just click on it and you'll be right in there, and it'll be really great. You'll be able to go page by page with us throughout the entire tutorial, and I think your learning curve will be a lot faster. Also, from Lincoln Benefit Life, of course, our sponsor and a subsidiary of Allstate, they have a great page, and the actual URL is at the bottom of the screen, as well as it's on our search engine optimization description attached to the video. When you see that, you can just go ahead and cut and paste it because it's really long, and rather than me tell you, it's right there. So you can go ahead and do that. And when you come to this page, there's a lot of good helps, marketing campaign helps here and understanding. And I like Facts of Your Life booklet. It comes in a book form or email form. If you go out to the site, just click on it. It's a great harvesting of client data, really a great data collector, and I think you'd really enjoy it. So go ahead and get it. It's absolutely free. And also out there is their prospecting letters and their postcard prospecting system, because it's really good to get in front of a client, and you can use these as soon as you get it cleared. Now, it is already cleared through Allstate, but if you're FINRA licensed, you're going to need to have your compliance department also look at this and clear it for your use. You'll find it's really amazing. And the last thing I want to talk about before we get going today is our own website. If you say, a lot of times I get email, hey Steve, I fell behind, or where can I get this, or where can I tell people to go? Well, if you want to say, Steve, I missed the Business Insurance Zone, I missed your Welcome to the Weekend, or any of our Edutrainment workshops, you can go out to our site, www.brokersalliance.com. As soon as you come to our homepage, it's right there in the upper right-hand corner. You'll see that big red button, On Demand Videos. Just click on it, and you'll be right there, and you'll be able to go ahead and look at any of our our previous workshops. And remember, we still recommend that you start from the beginning, and I know we're into it a lot. It's a 60 video series, 15 minutes a day. We recommend that you go all the way back. Now, to talk about this, I want to be able to do one thing and show you some basic ideas. And when I do that, remember, anything we show you here, you can always order at thebiz@brokersalliance.com. That's THEBIZ at brokersalliance.com, any of our PDFs. But also we want to recommend that we're using some documentation from lifespecs.com. The person who actually manufactures and distributed and created is Cheryl Moore, the United States leading authority on Index Universal Life, and some of the material I'm using today is right off that site. If you don't have this site, if you don't have this software, and you are heavily involved in indexing, that site is golden. It's lifespecs.com, and of course, they also do a annuity version of that as well. Now, what I'm going to do is I'm going to walk over to the board, and we're going to go ahead and walk you through some of the basics right off lifespecs.com. Okay, we're on lifespecs.com on their basic section of their website. And I like this because it really lays it out. Cheryl's done a great job laying this out for us in an easy to understand graph. And of course, that's one of our main goals in our instruction, on our videos, is keeps up basic on an entry-level course like this. Now, what she did was she laid out the graph with guaranteed interest, upside potential, and index participation, and the client's risk tolerance. Now, if you look at this, what she's done is she's broken it into 3 different categories. One is current assumption UL, whatever the fixed interest rate is. She's talked about indexed in the middle, and then at the bottom, a variable contract. Now remember, right from the get-go, I just want to explain again, a variable contract is a security. Unless you're licensed minimum Series 6 and 63 and have a relationship with a bona fide broker-dealer, you cannot sell variable. So just a heads up. However, in contrast, indexing and current assumption UL are both life insurance contracts. They're not security, and as long as you're duly licensed for life insurance in your state, you can sell this. And remember, always make sure that the product that you're using is also okayed and approved in that state as well. Now, when I'm looking at this grid, I really like it because it's a basic grid, yes, but it really formats my thinking and it helps you understand. The first one they're going to talk about is fixed, traditional, or as I call it, current company practice UL, current company assumption UL, and their typical guaranteed rate is around 2%. Then they show that the upside potential is limited, and it could be limited to what? The prevailing interest rates. And as interest rates fall, and I noticed that again, Europe and China just dropped their interest rates, we probably are going to see a little bit more downward pressure before we level out, and hopefully we see some increasing rates. Of course, if you're in debt, this is a great time to get out of debt because the rates are so low, not double down and take more out. When I'm looking at this, the client's risk is very low. There is some risk here because the actual numbers could default, the actual interest rate credited could default to its guarantees, and those guarantees could be punitive enough that there actually wouldn't be any, and you may have to come back with more premium. So just a heads up, it's a low risk, but it is a risk. The second thing is indexing typically has 0 annual accumulated guarantee, but some contracts have 1%, some even allow 3%, which is really unbelievable because I've noticed though, it's unbelievable because it's 3%. It may be able to eat all the expense loads of the policy, but usually contracts with good guarantees like this on an IUL platform are going to have lower caps, lower participation rates, and lower spreads. So you remember, you're getting two things here. You have to say, well, I am getting my guarantees, but I may not make as much as I would have if I would have had a contract that was a lot lower in guarantees to give me some upside potential. You just have to look at it and see which way you want to go. It has limited caps. Right now, I think the leading cap as of this date is about 17%, which is really a high cap and a huge double-digit cap at that. And then, of course, the index participation, the gains are based on the performance of the external index. Now, we're going to be talking about this throughout the week, that there's actual access to domestic as well as foreign, and some use single indices at any one time that you choose, and some will use multiple indices and let you choose those, which one's going to be the best one after the fact. I kind of like that. So you might want to look at that. And the exposure or the actual client risk is somewhat moderate. Remember, if I didn't gain anything, as I said yesterday, in 2001, in 2002, and 2003, yes, I got credited 0, I didn't lose anything, but I still had expenses to pay at the current company practice, and could it default? Could it default to maximum charges? It could. So you just got to remember, see what you're saying. So there is some moderate risk to this. And then variable, of course, as I talked before, the only guaranteed interest is their fixed account. And some people say that the fixed account still, in some contracts, are still pretty much over 3, but the problem with that is that the expense loads on VUL plus the M&E charges of the actual account could make it not really worth looking at. But again, some of them have some decent rates, and you'd have to look at that. The upside potential is unlimited. There is no spreads. There is no cap. There's not anything like participation rates. And if you use the S&P, the dividends are actually included, whereas in indexing, it's not. So it's just a heads up there, but look at the client risk. It's high. Not only could they lose all their money in their position, but they'd still have expense loads on top of that. And from 2008, that whole era, all the way up to 2009 when it started leveling out, VUL contracts got punished big time. And so you have to have a client that understands the market, can take that kind of a hit, and the exposure that this was, the exposure for the client on extreme risk tolerance, well, we saw that, and I always use that as my basic idea. Do you want to do VUL or do you want to do indexing? I still want the upward potential, I want the upside potential, but I may not want to participate in the downside risk. That is the big, what I would call the big zinger when you're talking about indexing. Really, we're really protecting the downside, with the exception of policy expenses, which they all have. but we have some potential to go upside. Maybe not as big as variable, which has an unlimited cap, but again, protecting, trying to make sure we understand. And when I talk about risk tolerance, we talked about this about a month and a half back. When I think about client risk tolerance, I'm looking at the client's ability to take a loss. And if my client says, I have no psychological chutzpah to take on a loss, I'm not going to go ahead and assign that. And we have a battery of questions for a client using a client tolerance test to kind of see where the client is and see their long-term objectives. And one of those long-term objectives, I have to think that way when I'm purchasing this. I really have a problem when I'm shorter. Probably the shortest I like to see is really 10 years. One of the things we're going to talk about tomorrow are the cap rates, the participation rates, and the spread rates. The farther I get out past 10 years, the more those three items, because everybody else says, is it better to go cap? Is it better to go participation rate? Is it better to go spread? After 10 years, it pretty much doesn't matter. I know that there's some people howling when I say this, but I've looked at the numbers. Once you get past it, it's probably not that big a deal. What is a big deal, though, is you're going to have to ask questions like, do you want annual point-to-point? Do you want 5-year point-to-point or 2-year point-to-point? Whenever I start the clock, do I want to go monthly? Do I think that carriers that give daily sweeps have an advantage? We just have to look at that and say, after a certain amount of time, when I get past 10 years, all those items become not as important and probably not a great sales. It wouldn't be a close on my part, I can tell you that. So now when I'm looking at this, I've looked at the basic three. Now, of course, the last universal life that's not in here is really guaranteed universal life, was generally used as an indemnification scenario. Now, people like upside potential for all these three because it has cash accumulation. If I have cash accumulation, it's really great for the contract because I have access to that cash. In income scenarios, which we're going to talk about Friday, you're going to notice that these three all have advantages. You'll have to see which one your client's risk tolerance will really work for, and then you can start to measure, where should I put my client? Most clients are okay with understanding that indexing less the policy fee is a pretty good deal because it's protecting the downside and having the potential, especially in this example, 17% with one of our carriers. So when you want to sit there and really measure out what's the great deal, I want to know what my premium tolerance is for my client. I want to know how long they want to hold this. I love to see no less than 10 years. I'm really looking for a lot longer than that because I'm going to take lifetime income, and I'm going to have some kind of income that I'm going to use policy loans for. I have to keep the contract in force for the life of the insured, and I can't have any default, whether lapse or policy loan. I took too much policy loans out. All those things are a mitigating issue. And one of the last things that I want to bring up is policy loans. Policy loans are based on 4 basic platforms: zero net cost loans, wash loans, spread loans, and arbitrage, or they call them participating loans in indexing. I don't like that word only because sometimes it's confused with whole life, which is participating with dividends. Now, when I'm thinking about this, many people say, what's the current company practice loan and what's the contractual guarantee? Is the loan fixed or is the loan variable? And then I ask all those questions. Is it zero net cost loans, wash loans, spread loans, or direct recognition loans? It all matters in the mechanics, especially when you're generating an illustration stream. Now, remember the good and the bad. If I showed you, as I did yesterday, that the S&P in the last 10 years had 4 terrible years, 2001, 2, 3, and 2008. And if I was taking distributions during that time, and I was taking arbitraged loans, I didn't make anything those years. So that means that those accounts were actually getting nothing credited but heads up. If they were on a fixed rate platform of 5%, they still had to pay 5% loans for distribution. So you just got to remember that there's mechanics here. In case of the worst scenario, and I just gave you 4 out of the last 10 years, the worst scenario that we've experienced in modern times, you want to make sure your client understands what they're getting into. I like the best loan privileges that cost my client the least. And if I can get them in a guaranteed platform, wow, that's even better. One of our features of our sponsor, Lincoln Benefit Life, is they guarantee zero net cost loans, guaranteed in the contract day one. And I think that is a huge issue. If I needed to go to their actual provision for that, I could also punt in bad boy years, right, and use withdrawals to basis. That's the basic tenet of Index Universal Life.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.